So I'm just going to give like a quick intro about what we do. See, we have a lot of people joining us for the first time, so just to understand what the community is about. So Startup Grind is the world's largest community of startup founders and innovators and creators. We do this through our local events as well as our flagship conferences. I'm going to talk a bit about our flagship conference. And collectively, we reach over 4 million individuals worldwide. And we feature London entrepreneurs monthly through our non-profit activities like events like this. And our mantra of what we stand for, these are our pillars, right? We believe in helping others. So if you attend any of our events, the first thing you want to do is help others. Don't look out to be helped. Just ask, how can I help you? Or how can I assist you what you're building? Another thing is give first. So you give before you take. So you're definitely going to be connecting with a lot of people here. So ask them, what can I give you? How can I support you? And what we're hoping to do with our event is also to educate the ecosystem. And also we want you to make friends and connections. So when you're looking out to people, don't try to, generate leads with conversation. Don't try to qualify leads. What you're looking for is for you to, make friends and make deep connections. And also, we hope our event also get to inspire you and be a source of inspiration for you to go do something tangible in the world. And this is our team. We have Prem, Peter, who is not here with us today, and that's me. And we've got Matt. Matt, can you wave at the house? Thank you. We've got Eleanor. Eleanor put a lot of work to make this event a success today, but she's not here with us as well. We've got Gabriel. Gabriel is also not here with us today. So, yeah. Where to find us. So for those joining us for the first time, if you want to learn more about what we do, you want to learn more about our events, this is where to find us. Go to www.startupgrind.com/London. We also have social media pages, so we share all of our events and our activities on social media, most especially LinkedIn. So find us on LinkedIn, Startup Grind London, and you'll be able to connect with us on there. And this is what the agenda looks like. We're a bit late, but we're going to try to wrap up time. We'd like to give more time for networking, for people to talk, because that's where the magic happens. And I want to say thank you to our sponsors in the room today. These are the people that make it possible for us to be able to host events like this regularly. We've got Howard Kennedy. I'm going to be inviting them up on stage very soon. We've also got Carter. And we've got Vanta. So I'm going to be talking briefly about what they do and how they're looking to support you. And also, we also have got partners as well. So one of our partners is Supreme Factory, and we've also got Runway East. So Runway East provides us this space, this venue, wonderful venue for us to host our community members. I've got meetupvideo.com. So yeah, that's our videography team over there, supporting us with our content. And briefly, I want to talk about our conference. So we host a global conference every year in San Francisco, Silicon Valley. And this year's conference is going to be around April 28th to 30th. So it's going to be happening in Redwood City, California. It's available for everyone. So if you're looking to connect with the Silicon Valley market, you want to connect, with founders, investors, partners, or anything, it's a great experience. I was there last year. We took a delegation of founders to Silicon Valley last year. It was a great experience. If you want to attend, I've got some complimentary tickets I can give out, but just 2 or 3. So yeah. So you don't hound me. Yeah. So, but yeah, it's an amazing conference. I can't talk about it enough, right? There are a lot of videos. Just go on social media and just type Startup Grind Global Conference, and you see what I'm talking about. And we are also hosting an ecosystem dinner. This is a low-key thing. You can't find this online, right? So if you want to attend, so if you're attending the conference and you want to attend this dinner, let me know. So we're facilitating a connection between London-based founders and San Francisco investors. So yeah, so if you're part of the delegation going to this conference, let me know. So we're able to add you to the RSVP. Yeah. And now I'm going to call Howard Kennedy to come up stage to give us a shout. Please, let's give him a round of applause. Thank you.
Thank you very much. So, hi, my name is Alex Watt. I'm one of the partners at Howard Kennedy. I'm not going to speak for very long because we're just a sponsor and we're lawyers. They're quite boring. But I am going to talk to you a little bit about the startup program that we have, because I know there's lots of startups in the room, and the startup program is intended to do everything we can to help you guys. So the startup program is essentially it's a massive discount on our fees, up to 30% of our fees off. It's introducing you guys to our networks, making sure that they've got 3 networks. There's a NED network where if you're looking for a little bit of grey hair, if you're a founder, some experience, Vicasso network will help you with that. Kaiko, putting founders in touch with investors, and just our Ignite network. Is a fantastic way of meeting people and finding funds and taking yourself to the next level. The other thing that we do is we provide people with access to the offices. Loads of you working in shared workspace now and WeWork, but you probably don't want to meet your bank in a WeWork, so you can use Howard Kennedy's offices. They're quite nice offices, and thank you. And we'd love to have you. More than anything, though, I'm really up here to say thank you, because we love being involved with Startup Grind. It is such a great organisation, and I'm really excited about the talk this evening of Ascension. It's the largest impact investor in the UK. Very, very exciting. So yeah, looking forward to that. Hopefully see you guys later on afterwards. Thank you very much.
Thank you. Thank you. Okay.
There is one other thing, which I can now say, because they've just arrived. We're partnering with Born, who are a PR company, and who are mirroring our discount. So if you come to us and you get into the program, then you will also get a discount on PR as well.
Thank you. So the interesting thing is that we try to get some of the best partners to, that can offer value to startups, to founders, right? And that's why we do this. So our next partner is Carter. Anyone from Carter in the room, please come up on stage. Let's give him a round of applause, please.
Hi, thank you so much for having us, and it's great to be sponsoring this event today. So basically what Carter does, if you don't know, is equity management platform. Does what it says on the tin, does a bit of cap table management, fundraising, compliance, share option schemes, all of the above here. The main reason we're here today is for you guys here as founders to kind of get you through those kind of big milestones as founders. And the main reason also is that the Spring Summit, we are launching the first ever for Carter. Carter being a US platform, US-centric business. They've kind of gone across the pond over to the UK and Europe here. So to give insights to kind of where the fundraising journey is right now, where the market is, it's going to have talks from the top VCs, private equity firms, GPs, lawyers, all of the above. So yeah, we'll be here kind of all evening, so please feel free to take a picture. We'll send this all out if it hasn't been sent out, for any links for everyone to kind of get tickets. And yeah, just once again, thank you for having us, Sam. And yeah, this is a great event for all of you guys. So cheers. Thank you.
Thank you. Yeah, so this event is going to be like a very amazing event. I've seen the speaker list. I just wanted to ask, is anyone raising or fundraising at the moment, please? Okay, that's a good number. So have anyone heard of SEIS, right? Trying to set up SEIS. So Carter is a partner for that. So they've got like amazing discounts for founders trying to set that up. So it's great to set it up on their platform. And they've also got like an amazing cap table management system platform. And I think that's one of the best in the market at the moment. So they've got amazing discount for founders. They've also made it very simple, like a SaaS model where you're able to like pay a particular token and you're able to use to like manage the platform. So yeah, take advantage of that. And if you're a member of Startup Grind, you get a good number of discounts from that as well. So is anyone from Vanta in the room today? Okay, so I'm just going to do a quick intro about Vanta. So I say, there's this popular saying on the street that says, America innovates and Europe what? Europe regulates. Yeah, thank you. So if you're building a company in the UK, or if you're building a company in Europe, yeah. So if you're building a company in Europe and you're trying to, navigate the regulatory landscape, right? That's where you need Vanta, right? Many of you are building in healthcare. Many of you are building in some heavily, regulated space, right? You need Vanta. And the interesting thing is that instead of going through the process of registering, like, the self-serve model, if you come to any of us, like maybe come to meet me or come meet Matt, we're able to introduce you to an account executive that's going to hold your hand through the process, right? Some regulation you don't know you need, even if you want to do like a call, like just to understand what kind of regulation you get to navigate in your business, right? You get to get an opportunity to do that. So yeah, this is Vanta. You also get some credits and discounts from going into Startup Grind. And that's it for now. I'm going to invite Mark and John up on stage to give us the five-star chat. So let's give them a round of applause, please. Okay. Good.
Thank you.
All right. Yes, for you.
Thanks.
Yes, for you.
So, we are very lucky tonight to have Jean from Ascension, who are a VC investor with over 100 million in assets under management. They have consistently been recognised by Beauhurst as one of the most active impact and venture capital investors in London. And since 2015, they have achieved 14 successful exits. Jean himself from Montreal founded Ascension in 2015 and has over 25 years experience working in technology, innovation and venture. Prior to this role, his roles included Head of Distribution at MTV Europe, if anybody remembers that, and leading the sale of Two-Way Media to Virgin Media. We're going to have some Q&A time at the end, so please hold your questions until then. But we're just going to have a chat with Jean to start off with. So maybe we could start with just where you are at the moment, what you do with Ascension, and just talk about some of the investments that you make. So obviously you have over 150 investments now. What do those investments have in common? What do you look for in an investment? What is a good investment?
Yeah, thanks very much, and nice to see everybody here, and thanks for coming. So we've done about 186 investments in the last decade. We do mainly pre-seed and seed. We started off as an SEIS fund in 2015, and then started doing EIS funds in 2017, and then our first institutional fund in 2018. So I think if you're fundraising, it's not that important, but it's interesting for you to understand some funds that you'll talk to will be SEIS, EIS funds. Others will be institutional funds. So they have different investor bases and sometimes different profiles. But what we look for, our favorite place to invest is pre-seed. So I would say 75% of all investments that we do is pre-seed. Pre-seed is like the first check, right? So typically somebody raising between 500 and £1 million. And then our second favorite place to invest is seed, which is, the next, if you graduate up to seed, and that's typically between 1 and 2 million. Obviously, you can find pre-seed deals at 5 million or 2 million, but we, the market's that. So our ideal, team is we like at least 2 co-founders, and just because that's what we like doesn't mean other funds that like solo founders and but we like 2 co-founders. Typically, one is, very technically based because we're investing in software companies. So having that superpower of somebody building the business from a technology perspective is super important. And then the other co-founder tends to be more, sales, marketing, go-to-market. So that's the basis of what we're looking for.
Excellent. And just touching upon that point, you've talked about the different funds. So you have your institutional investors, your CEIS funds, your EIS funds. Are they looking for different investment opportunities, or will they look at a broad spectrum of different opportunities?
So in 2018 we started our first institutional funds, and those have like specific theses which are impact. So I would say so I'm the managing partner of Ascension, so I kind of set the whole thing up. And historically, I used to be involved in every fund. But about 2 years ago, I moved away from anything that was EIS, SEIS, to only focus on the institutional funds, which have an impact thesis. And the impact is typically around reducing social inequalities. So my personal interest is only in impact, but we call it tech for good, because as soon as you say impact to an investor, they kind of run for the hills and think that impact means you're going to make less money than something that's not impact. And there are many different spectrums of impact. There's charities and kicks and nonprofits and grant money, but we're on the kind of highly commercial end of impact. So businesses where there seems to be a lockstep between the business growing and the impact of that business scaling. And in the impact space, you can break that down into helping the planet or helping people. So my focus is more on the people side, which could be health tech, economic opportunity, financial inclusion. So we're really focused on how can we leverage tech to reduce social inequalities in the UK initially, but all solutions that we tend to back are global. And then the SEIS, EIS funds are generalist funds, so they can invest in anything, ideally not arms, tobacco, and booze. But they can invest in non-emission-driven businesses. But what we have in common is we like pre-seed and seed any of the funds that we have.
Excellent. And for the guys out there that are looking to start up and start their own business, what are the red flags that you guys are looking at? Is there anything in a business that you see and you immediately think, no, that's not one for us, that's not one that we're going to invest in?
Well, I mean, there are lots of red flags. I mean, one red flag would be, because going down the founder route is painful, and typically you either get paid nothing when you're starting out, or you get paid very little even if you raise a pre-seed round. So it's challenging. So sometimes you might come across a founder that's like, I'm working full time at company X, and that's typically how it starts, right? You're working, you're making an income, and maybe in the evenings on weekends you're building an MVP and you're starting, and that's great. That's how it starts. But at some point, if you want to raise money, you got to go full time. You can't say, I need this salary because I've got a mortgage. I want to send my kids to school. So I think that's quite tricky. Is when you find a good founder that is in a job and not 100% committed, because unless you're doing this 110% only whatever business you're building, you're likely to fail even if you are giving it 110%. So anything less than that, and you're pretty much guaranteed to fail. So that's a red flag, is somebody who's not fully committed to that. I mean, there are many that we can go through, but that's one, if you're looking for the main one.
So I wanted to touch upon something you mentioned at the beginning. So one of the things you talked about was you like to have two founders in the business.
Yeah.
If you have a business that you really like that only has one founder, is that something you can overlook? Is that something you get around, or
Yeah,
how does that
so
work?
we get around everything. We don't we typically don't like business to consumer. We typically don't like hardware. We typically don't like sole founders. You will find all of those things in our portfolio. So fundamentally, because hardware is tough, B2C, we don't like businesses that rely on paying Google and Facebook loads of money in order to scale. So one of the things we really look at is distribution. What's your route to market, which is why we like B2B and B2B2C, because there are clear routes to market that don't rely on advertising. But yeah.
And then turning it around for these guys in the audience, what do you think makes a good investor? What sets you apart from other investors? What should these guys be looking for in a partner? It's not just about money, it's obviously about a lot more than that. So what do you think makes you a good investor?
Yeah, there's quite a bit of talk about good investor, bad investor. I mean, at the end of the day, I think raising money is the most important thing. Money is oxygen. If you don't have money, you die. As a business, obviously, venture capital and raising money is not. You can grow and organically grow a business and get revenues and keep going. So you don't need to raise money. And if you can avoid raising money, that's great. But if you are going down a business that needs money, so I would say you've got top tier investors, and then you've got less so. But I think any money is good money, and then we can talk about fees, and people get very emotional about fees. But a bad investor for me at pre-seed and seed would be somebody who's really obsessed about control and your actual like financial model. Somebody who's super obsessed about like the minutia of your P&L and wants to kind of treat you as if it's a private equity deal. And I would say the best way to check that, if you are going to take money from them, is to say, can I speak to some of your portfolio companies? And then if they have a website, which hopefully they do, then, or it could be an angel, then go onto their website and randomly choose, some of their portfolio to speak to, or do it discreetly through LinkedIn. But yeah, if the portfolio doesn't like them, then that's a red flag.
Yeah, absolutely. And again, sticking with these guys, and one of the guys in the audience comes to you with a proposition. Mm. How do they make that stand out to you? I mean, obviously, you're seeing a lot of propositions on a daily basis. How do these guys make their proposition stand out to you?
So we've done this exercise because we're also raising money for our funds, and we look at our deal flow, and so we get about 7,500 deals a year that we assess. 3,500 come through our website. 3,500 come from going to demo days, coming to events like this, and warm introductions. Now, as an impact VC and as somebody who believes that everybody should have access to capital, we have a website, we have an application form. I respond to everybody on LinkedIn that reaches out to me. But in the last 24 months, we've invested in one company that's come cold through the website out of probably 30 new investments that we've done. So 1 in 30. So the amount of time that my associates spend wading through 3,500 deals isn't great. So although we want to be open, and that's the reason we have a website and people can apply, a warm introduction that helps you, elevate yourself from everything else, which could be one of the founders from our portfolio. It could be a law firm. It could be an angel investor that knows us, it's already committed 35K to your round. There's a bit of hustle involved, and you could argue, oh, well, that's just for people that are connected. But the flip side is, like, if you can't get to somebody at Ascension through our 30 mentors, 16 venture partners, 13 staff, thousands of investors and law firms that we've co-invested, like, if you can't get to us through a warm introduction, then how are you going to get, like, your first 100 clients?
Yeah, exactly. I think that's a really good point. And is the stage of the journey of the business important to you? Do you expect different things from pre-seed to Series A, or is it very much the business that you're looking at rather than the stage that the business is at?
Yeah, so this is when I had some funny slides I did, but so when you're doing pre-seed, no, we're not going to put them on, but when you're doing pre-seed, there's this, you're probably too young to remember, there's a guy called Donald Rumsfeld during the first Iraq War who was talking about, like, known knowns and known unknowns and unknown unknowns. When you're a pre-seed investor, it's unknown unknown. So basically, everything that we're looking at is unknown. And if you think about what fundamentally is a business, right? What is a business? A business is X times Y times Z. X is the unit price that you're selling something at. It could be a $9.99 monthly subscription to a human. It could be a £50 a month SaaS fee to an enterprise. But that is X. Y is how many people are buying that product, and Z is how fast are you growing month on month. When you're at pre-seed, X, Y, and Z are all assumptions from you guys. You guys are giving us assumptions. I am a risk-averse investor. So all you need to do when you're pitching a pre-seed investor is convince somehow in your deck, understand what X, Y, and Z is. And if you're saying it's $9.99 for this thing a month, like, how can you make that so that an unknown for me becomes something, oh, I can believe that. And then the next one is, what's your route to market? How are you going to get 100 customers a month? And then how are you going to grow to 1,000 customers a month? So if you can take each of those unknowns and have a credible story of how I can look at each one of those things in isolation and say, yeah, he'll pay $9.99 for that. I believe that tick. Oh, yeah, that route to market, that idea, that LOI, this pipeline. Oh, I can see how you can get 100 customers. Oh, I can see how you can then grow beyond your early adopters. Then those three things that scare me, I can believe. If I believe those three things, then I believe your business model. So focus on that and try and deconstruct your Excel spreadsheet into your deck and just take all of those unknowns away into something that's credible and believable, and you're done. And then, because that's an important point, what I just said. But pre-seed is X, Y, and Z are unknowns. By the time you get to seed, X is typically known. What people are willing to pay is known. So as a seed investor, the only things I don't know now are Y and Z. I don't know how many customers you can get and your rate of monthly growth. By the time we get to Series A, X and Y are known, and the only thing a Series A investor is looking at is, can you grow 20% month on month or more? And so each time, those unknowns become known, and then it's just about growth.
That's really interesting. It's really interesting to have it broken down in that simple way. Like, that's fascinating.
Well, it's simple.
Yeah.
And just keep it simple and keep it clear and just prove each of those unknowns. Oh. Sorry, you want me to move? Oh, forward. Yeah, that light is killing me.
There you go. And then, Jean, how much are you thinking about the founders themselves? You know, how much are you looking into their personal brand? How much are you looking into LinkedIn profiles and what that founder brings to the business? Or is it very much focused on the business?
No, so when I started this 10 years ago and went to similar events to this, and you have, you know, experienced VCs up on stage, and when they're saying, what's the most important thing? And they'll say founder, founder, founder. And it's true. So fundamentally, the founders or founder is the most important thing at pre-seed. Once you get later stage, you know, you can get fired or you can become what we call a scrum half or an ambassador to the business after Series A, and they can bring in, you know, somebody who can scale the business who's a professional CEO. But for those first 3 or 4 years, the founder is absolutely fundamental. And so we spend a lot of time, and we've got like a 90 question questionnaire that we will subtly, subliminally go through with you through our 5 or 6 Zoom calls and meetings that we'll have with you, and we'll score them, and we have 5 founder traits that we look for. So I've broken down the traits. I've then broken down, in order to understand if you're dealing with a narcissist or if you're dealing with somebody who's not self-aware, how do you know that? What question can you ask? So I've actually kind of tried to distill this into a formula that is our playbook, that when I have a young associate. So this is the other thing. When people are moaning on LinkedIn, oh, I'm speaking to the associates are actually the most important person, because the associate is the gatekeeper to the more senior people, because we look at 7,500 deals a year. I cannot be the front line on that. I can only be the last line of defense when my team wants to do a deal, because otherwise I wouldn't see my kids, I wouldn't be here tonight, I wouldn't, you know, play tennis on the weekends, I would just be working the whole time. So the associate is important. Anyways, that's the digression.
No, that sounds good. It's fascinating. And so now we've got the money in the bank, the check arrives from you guys. How do you make that money last? What's the most important thing that you do with that money as a startup?
The most important thing is when you come to us, we want 18 months runway, assuming no revenue growth. So if you're a pre-seed business, typically your revenue is 0. If you're a seed business, it might be 20, 30K a month. But whatever it is, it's no growth. So, and we want 18 months runway. So what that means is if you're doing 20K a month, 20 times 18 is whatever, 300K. So we'll let you have that 300K as, you know, pretty much net revenue that's going to be cash flow. And then if you're raising, I don't know, £1 million, so that's that £1 million that you've raised plus your 300K in revenues, that 1.3 needs, so your cost base needs to be 1.3 million divided by 18 months. So and it used to be 12 months when the times were good. Times are more difficult, takes longer to raise, so we've moved that to 18 months in the last 3 years. So what that means is you've got 12 months to not worry about fundraising, to only focus on execution and, you know, getting traction for your next round. So the second thing we do is we define by month 9, 10, 12, like what traction do you need to raise your next round at a higher valuation? Because if you can't raise, our money's down the drain. If you raise at a down round, it makes us look stupid. So we want you guys to raise at an up round and keep going on the merry journey of venture capital through the circles. So by having 18 months, by month 12, we tap you on the shoulder and you say, okay, do you remember we said 18 months? Well, 12 months is up. We need to now fundraise, and hopefully you've done something and we've helped you do something in those 12 months that means you can raise at a higher valuation.
And do you see any common mistakes with founders? The money arrives. Is there any, the boat party in Marbella, that kind of thing? Is that? Do you see that or?
No, the biggest mistake is so everybody you hire, 50% of them won't work out. So, be careful who you co-found a business with, be careful how you give your equity away. So when we talk about reverse vesting, now 10 years ago I talked about reverse vesting and people would chase me around with pitchforks because they thought I'm trying to take their business, because somehow there was this misconception that because you come to us and you own 100% of the business, or your two co-founders owning 50-50, then we come to you and say, we're now going to reverse vest your shares, so you don't really own 50% anymore. In 4 years you will. And then that's quite an emotional thing. It happened to me when I was a founder too. I was kind of freaked out that I had to give up. You're not really giving it up, but if you leave it, and there's this perception that it somehow comes to the investors and they're somehow going to fire you. But at pre-seed, we don't have the ability to fire you. We don't control the board. But if you do have a divorce with your co-founder and they walk out with half the business and they go off to Google and start working on a 200 grand a year salary and you're still on 40K a year, you're not going to feel great about that. And that's considered dead equity. So I would say being careful with your hires, with your equity. And then the final thing is, so your next funding round. So if you assume every round that you raise, you're going to get diluted by 20%, what do you want to do as a founder? So you've done your pre-seed round. Do you want to do the seed round and the seed plus round and the Series A round? Or do you want to go straight from pre-seed to Series A? Because if you do the seed round, the seed plus round, the Series A round, you're getting diluted 20% each time. Boom, boom, boom. So you want to go from pre-seed to Series A, right?
Yeah.
Of course you do. But your metrics may not be Series A. So you're going to say you've raised 500K, then we talk to you and you're like, I'm going to go raise £5 million, and that means it's going to be a 25 million valuation. So you're like, I'm exaggerating here, but so what I try and tell people is maybe start a bit lower and then overfund. So the worst thing you can do is say, I'm going to go raise a 2 million seed round. You've got £1 million of commitments. And I had a picture of somebody with a horse and carriage, an old Soviet Lada, and then a kind of Porsche. You want to move at pre-seed, you guys are the horse and carriage, and you want to move to the Porsche. But if you go to investors and say, I'm raising 2 million or 5 million, then you come back 3 months later and you say, I said I needed 5 million, and you've got 2 million of commitment, so you come back and say, I only need 2 million. That gives the investors pause, because I think you said you needed 5. So it's better to start with 2, if that's a realistic target, and then say I'm overfunding because I'm oversubscribed. Because then that's the opposite of saying, oh, I've gone from 5 million to 2.
Interesting. And speaking about that first 12-month period, how often should the founders be expecting to see you? How often are you going to interact with them and be in the business? Is that a monthly thing? Is it a quarterly thing? Or how does that work?
So again, we've got our institutional funds, which are the ones I work on. We're slightly more proactive because we're putting bigger checks in, and we tend to lead the rounds. We tend to take a board seat or board observer. So we'll see you at all the board meetings, and then we like to see you. So typically that will be monthly or every 2 months. But board meetings are fine. They tend to be tick box exercises for the founders, just trying to reassure the investors that everything's fine. But so often I try and move those into more constructive meetings as opposed to just the founder, summarizing the progress of their business, which you can read in the board pack. But so I like to have one-on-one sessions with the founders where we can just speak about anything more honestly. And and I can be quite critical, but everything once we've invested, as long as you haven't lied to us, and that's never happened in our 100. We've never sued anybody. Nobody's really ever lied to us. People may have exaggerated things, but unless that's happened, we're on the same side. And even if it's disappointing, we're still trying to find solutions together.
And are there any particular warning signs that you're looking for in that first 12-month period? Is there anything that you're watching out for that you would be worried about, or is it very much, trusting the founder to go ahead with the business?
Well, I mean, the biggest thing is founder fallout. That I think 65% of businesses fail because founders fall out, because if 50% of marriages fail because people don't get on, then you can imagine founders is like a marriage. Yeah.
So if 50% of the businesses fail because founders fall out, then why wouldn't you consider, for example, solo founders?
Well, that's why some people love solo founders. The reason we don't like solo founders is we think that the technology is super important, and we think as a pre-seed business, if you don't have somebody, so one person is out there selling, and I'm going to be mean to the techies in the room. The techie in my kind of weird animated world or vision is like in a dark room with no lights on, just coding 18 hours a day. So while the other one's running around trying to generate revenues, the other one's just building something. And the alternative of that is to use freelancers or agencies. Agencies are super expensive, and freelancers, you pay peanuts and sometimes you get monkeys. So, we're backing a technology business, so we want that talent of that technical person is as important as the salesy person.
What if you, for example, in my case, I'll say, so like I have technical-ish background, meaning like I have background in program management, so I can do like risk management. I started working with an agency, and then onboarded them as my employees, and give them 1% of equity from a PE evaluation stock option first, with obviously all the necessary conditions. So they're part of my team. They have a stake in the business. So
And we have done stuff like that. So we have done work where agencies, are coming in for equity. It's just, I think when you're at pre-seed and you're pivoting and you're moving fast and you're learning, having that knowledge and that leadership in-house for us is important.
And just pulling it back before we start the Q&A at the end, again, just bringing it back to how you make investments or how you're choosing your business. How much of that is based on the data and models, and how much of that is just a good old gut feeling about a business and a founder?
So we're using AI a fair amount for outreach to stealth founders, and it's being used, to help us with investment papers, help us due diligence, help us look at size of market. So we are using it for data, but yeah, I would say it's not so much gut. Like there was a slide that had like we write investment papers, and in those investment papers we'll have a competition slide, we'll have routes to market, founder characteristics. Like we have very detailed things, and across all of them we score through the questions we ask and the research we do, and then we've got, a VC doesn't know much. My background when I built a business was in digital media, so I'm now investing in health tech, energy, and fintech, which I have no operational experience in, but I've been doing it for investing in for 10 years. But what we do know is we've got people that we go to, so we get the sector expertise from our network, from our mentors and people that we know on LinkedIn. And then we have quite a detailed map of what we look for. But yeah, ultimately, it's gut. Like, all those things end up being gut. Like, you can research it all.
Yep.
But I mean, back when I was just started, I was making investment decisions after an hour meeting, just based on the founder. And I still think I could carry on doing that. Now, we've kind of professionalized it a bit.
And how many of those were successful investments? Do you feel like it was more successful?
My first 2015 fund, we've returned the fund and it's trading at 3x. My 2016 fund, we've returned the fund and it's trading at 5x, unrealized. So we've had exits, but anything that's exits, we've had anything from 1 to 10x exits. So anything that's going to exit early as a pre-seed investor is. But all the unrealized value where you're going to get the 10x plus is hopefully coming.
Excellent. And my final question is, you've talked about the different funds that you've raised. When you're looking at investments for those funds, is there a bit of you that's thinking, I need to spread the risk, I need to go into different areas, I need to go into different locations, or is it very much just about the business?
Well, we have different funds. I mean, the fund I work on, we do Europe, North America. We do pre-seed, seed. So we're pretty diversified. We're looking at how can we help low income, and low income for us is like half the population. So half the population is either in poverty, relative poverty, or living paycheck to paycheck. So we want technologies that are helping a mass market, and on the economic opportunity, it could be ed tech, HR tech, gig economy, infrastructure tools. On the reducing your cost of living could be energy, financial inclusion, and then democratizing access to better health is like, so we've got a lot to deal with. So we have diversification geographically. And then we do look a little bit at, how much B2C, because we have done a few B2Cs as well. Like what's B2C? We're now getting into a problem of we've got so many portfolio companies, we don't like to invest in competitive companies. So sometimes you'll meet a great company and we've invested in something else 3 years ago that's similar. And then I think sometimes you'll take a view, well, that one from 3 years ago is actually a zombie, so it doesn't really matter. But typically we don't like to invest in competitors. And they can overlap over time when people pivot, but.
Sounds good. Well, thank you very much. That was extremely interesting.
Thanks.
Guys, if you have any questions, could you raise your hand, and I think we'll bring a mic across to you.
Thank you very much. Do you have any standard deal structure that you go in from a pre-seed perspective or a seed perspective? And if not, what usually for you determines the deal structure of both sides?
I mean, I think our deal structure is, I think we've looked at Seed Camp and the BVCA and is it, so we just have a standard deal structure. So the things that typically, so we've got like quite a detailed term sheet. So we've got our schedule. We'll have the indemnities, the vesting schedule, investor consents. So we put like exactly what's going to be in the long form on the 4 things that people will get emotional about. We put in our term sheet so that when it goes to the lawyers, all the stuff that people don't like, we already know what people don't like because we've done hundreds of these deals. So we put that up front in the term sheet, and that way it's usually the founder and us negotiating, and then the legal fees stay much lower because you don't have 2 lawyers negotiating those terms. Sorry. So you do the difficult conversations up front during the term sheet, which is different from other people who might have a 2-page term sheet, and then that stuff comes later.
And how much flexibility is there in that? Is there a negotiation in that, or is it?
Yeah, I mean, there's some cases where the founder couldn't get their head around reverse vesting, and we took it out. And then in one case, they fell out with their founder, and 2 years later, he was like, fuck. And I was like, yeah, well, that's fucking why I told you about the reverse vesting, you idiot. So yeah, so we tend to not cave on that anymore. But whether it's 3 years or 4 years of reverse vesting, but if you're the CEO of a business, reverse vesting is good for you, assuming that you're not the one who's going to leave. So once you can get that into people's heads, that it's actually protected the company, because debt equity is something that can kill your company. And debt equity is when a founder leaves with 20% of the business. A co-founder leaves with 20% of the business.
I'll stand so you can see me. I feel like I want to kind of address the elephant in the room here, because there's a lot of conversation going in the back room between founders of something called traction.
Traction, yeah. That's the most important word.
Exactly. So we were told that things have changed. Now we don't, just a great idea is not enough anymore. So we need to work to find people, but we need to bootstrap. We can't have a job, otherwise we don't look like we're committed.
Yeah.
We need to find people, but we can't pay them because we are not earning money, and therefore we're not paying the mortgage and we're living under a bridge or whatever. So it is like a lot of pressure, and we understand also the other side. There's a lot of, being worried about, it's not just a good idea that makes the money in the end. But then how much traction is enough traction at pre-seed?
Yeah, I mean, it depends who you are, right? Like, my friend from business school, Eldar Tuvi, Vertis, which is this SaaS product, they raised like 20 million pre-seed round, and they wrote like 5 slides the night before because he had already exited 2 businesses for over 100 million each. So, but if we're talking about like a new founders, I mean, traction for us is an MVP has been built. Now, a lot of times the MVP gets thrown away a year later and rebuilt because it wasn't scalable, but at least it shows that you were either, outsourcing to an agency in some cases, but in most cases in our world, like, you've had somebody build something, and I think that's why you've had this tech revolution, the ability to build MVPs and to get something to market cheaply and through AWS. Initially, if you look back at the history of why Tech City exploded, it was people being able to piggyback on other people's servers. Like when I started investing 12 years ago, whatever. And traction for us is, I guess the key thing is insight. You've got a good idea. So insight is a good idea at an unfair advantage. So everybody can have a good idea, but an insight is a good idea and an unfair advantage over everybody else who might have the same idea. And an unfair advantage for us, coming back to, I think, your initial question, I forgot to answer this, is there's a lived experience of the problem, either in your personal life, if it's a femtech or health tech thing or something else, or, for example, Credit Kudos, we sold to Apple, and Freddie Kelly, the founder, moved to the US or the UK, and he was British. He couldn't open a bank account because there was no financial history on him. So he built Credit Kudos, sold it to Apple for $150 million. That was an insight. That was a lived experience of somebody with a job who couldn't open a bank account. And so for us, insight is traction. So it could be you figured out a route to market. You've been working, there's a guy in the back that worked at AWS for 10 years. So he's probably got some unfair advantage over the market that he's trying to bid. And he might have a bunch of B2B customers that he can bring on to help him. It doesn't have to be revenue in our case. It has to be, the more of those X, Y, and Zs that I've talked about that you can prove to me that you understand and that you can deliver whatever your business model says. And even if you deliver your business, I expect your year 2 numbers or your year 3 numbers to be year 5, So only one company out of 178 has ever like overpassed their revenue lines from the business plan they presented to me. So anything you present to me, I don't believe your revenues are going to be true, which is why I'm so obsessed about the cost base, because I know you're going to need as much runway as possible. But as long as whatever those big numbers are achievable at some point, and it may not be year 3, but it'll be year 5, I'm happy. So I don't know if I answered your question, but traction is a tough one. Depends on your business.
Thank you.
Hi, I've got a question on the financial modeling. So how important is the financial modeling at a pre-seed stage? Because, like your pre-revenue, pre-traction and everything, and all those numbers are still a projection. And based on your experience, how many of those startups have actually hit those numbers? And
No, they never hit the numbers on the revenue side, apart from one. But they're important. So the other slide I love is apart from the XYZ kind of that has to go through your pitch and your DD and is year 1, year 2, year 3. So again, you take whatever your 3-year plan is, and if I can see year 1 is, I'm going to have 20 clients. By the end of year 1, I'm going to have 20 clients paying £20,000. By the end of year 2, I'm going to have 50 clients, and I can see year 1, year 2, year 3, and then you can kind of talk me through how that's realistic, and I can see how you go from a kind of pre-seed business to something that's doing the magic number to get to Series A and beyond is like 100K MRR. If I can see 100K MRR, by year 2, year 3, and you can justify that and back it up, that's important. But yeah, the business model is important, like the fundamentals, right? Is your gross, like the more you grow revenues, hopefully, you're not your gross profit isn't negative. Like as you're growing revenues, your cost of sales are lower than your net revenue. Like your net revenues grow, and that over time that can cover your kind of fixed cost base, and that it can become, in our case, it can become over time a £500 million business. So you need to be able, in our world, by year 8, show us, or at least we need to believe that you can become a 50 million revenue business. But I don't expect an 8-year plan. I expect like a 3-year plan.
Hi, Jean. Thank you for that. Just on the founder side of things, I'm a founder, building a team, brought in technical expertise. But I'm interested to know, out of the 14 successful exits, narrow that down to the ones that have 10x, like what are the common traits? What do you see in those? Is it right place, right time? Is it a super solid team that are able to pivot and react to market conditions, particularly in the AI space at the moment, which is moving pretty quickly? But I'm just interested to know from those like top companies, what have you seen and what's common about them?
I think it's the ability to execute quickly, like, and this is in our DD. Like sometimes you'll have one meeting and then you're sold and you start the DD and you do a deal. Other founders we speak to over a 2 or 3 month, 4 month period, but like the ability to execute quickly. So every time you speak to them, what they told you last week, we were going to meet this company and see if we could get a partnership agreement, which is, traction is a route to market. We've talked to Ernst & Young and they may, sell our solution to they're going to integrate into their SME program and they have access to 1,000 SMEs and they're going to sell our SaaS solution. And we've already got an LOI, and this is the revenue split. And you're like, fuck, okay, I thought they just met like Ernst & Young last week. They've already got an LOI like that. And then suddenly your pipeline of I can reach 1,000 customers through E&Y, that's kind of traction, right? That's like, oh, fuck, okay. So that unknown of how you're going to get to 1,000 customers, and you're not going to convert all of them, but how are you going to get to 100 customers? Oh, that's converting just 10% of that E&Y pipeline. Okay. And if you had a case where they did something with another partner and they converted 10%, that's even better. Then that that why, that like how many customers can you get, that becomes a known to me. That becomes something I believe. Okay, I can believe he can get to 100 customers because one of his peers who did the exact same deal with Ernst & Young 2 years ago, by the end of year one, they had 100 customers through those 1,000 potential customers or whatever. So yeah, execution, speed of execution. And my most successful exit, they pivoted 4 times. And this will be a case study. We only exited half of it, so I'm still in it. But we invested, it was one of our first investments, 2015, put 120K in, got a 10x exit. We sold half. And now I think they're gonna be a unicorn. And yeah, he pivoted 4 times. I mean, I mentored him a lot, and he's like an investor in our funds now and a good friend, but unbelievable story.
Hi, yeah, my question's more on the GP LP side of things. I think it's fair to say that past performance is indicative of investor trust. From your non-traditional background from media, how were you able to raise the first fund and gain committed capital with institutional investors?
Yeah. Yes, I mean, I ran so I was at MTV, and then I ran a tech business called 2A Media that I founded in 2000. So this was in the kind of old technology days when I had to raise money off a PowerPoint presentation because AWS didn't exist. And I used to spend a couple £100,000 a year on what were called I call them server-side guys because they were mainly men. And I had to have 3 of them just to keep all these servers up so my coders could build on something. And then AWS allowed anybody to just start coding on top of an infrastructure, and then you had iOS and Android and other routes to market but it was a different time back then. So yeah, so I was I guess an operator, sold the business. I had an exit. It was an exit that allowed me to buy a house and create, like, send my kids to private school, but it wasn't like a lastminute.com, Brent Hoberman type thing. So I had to build Ascension organically. I started with a £1.2 million SEIS fund in 2015. And then a 1.2 million SEIS fund in 2016. These are small funds deploying annually, and then grew a track record. And as I said, those the early vintages are doing well. And so the early fundraising was through friends and family and people that I'd worked with and made a bit of money through when I was a founder. And then I started raising from institutional investors in 2018. So I had, at that point, a 3-year track record of investing, and some of those businesses were super interesting. And then I started down the impact route because I started to hypothesize that tech for good wasn't going to compromise returns. So then at that time, I attracted investors that thought impact was good and were looking for impact GPs or VCs. And there weren't many of them. There was Bethnal Green Ventures and Mustard Seed, and then us. So, but you know, any normal investor would run a mile if you said impact. And now I think our theory of change is that you can invest in these highly scalable, mission-driven businesses and have the same returns because they're solving big bloody problems, right?
Hi, sorry. Oh, sorry. Hi, sorry. I wanted to ask a question more on the investor side of things. You mentioned about having a zombie investment, which is obviously I'm taking to be somewhere that's not really making you the gains that you expected. And I think there's probably investors out here who've had similar experiences who invested in companies and they're maybe not even getting their money back or getting very minimal returns, or 1x, 2x back on it. And I guess my question is, what do you do about those? Like, do you stick? Do you twist? How do you make the most out of what you think to be a zombie investment?
Yeah, well, there are 3 ways it's going to go, right? It's going to fail, it's going to exit, or it's going to be something in between. Now, the something in between is what we would call a zombie. So a zombie, typically a zombie is a business that hasn't failed but is not really growing, but somehow they're surviving. They're surviving maybe because they're doing 30K MRR, and they've gone maybe from 10 people back to 4 people, and they're just break even. or they're raising a bit of money from friends and family, or they're somehow making it work. So, I mean, what do you do about those? I mean, we invite the founders to our pub club. We talk to them. If they want to speak, we're there. But at some point, like, we wouldn't put more money into those businesses, and I think the founders understand that because they can't raise money from anybody. And typically, when we do the first check, like, we have a rule where we can't lead any subsequent rounds, and we do that to protect the portfolio, because signaling is like a big deal. Like, so some VC funds will lead your round, and then they'll lead your subsequent rounds. But if they're known to do that in the market and they don't lead your round, then the other investors are like, why the fuck aren't they leading that round? It must be a bad business. So we don't lead any rounds after the initial investment that we do. Doesn't mean we won't maintain our stake or do our pro rata, but we'll need somebody else to come in, price it, and that protects the portfolio, the weaker ones in the portfolio, because then we can be the cheerleader for all of them.
I think there's a couple of questions up the back, and then we'll come back in.
Me, right?
Yeah, go for it.
Right. Yeah, I thought I would bring up a little personal case study that happened recently. So I'm a founder of pre-seed startup. We are bootstrapping at the moment, so just decided to raise, and we've got the basic product in the market, some traction, but we are not generating revenue yet, so you can imagine we don't have a queue of investors wanting to invest in us. Now, recently we were approached by a US-based VC fund, or rather we were introduced to them. Sounds great, right? So we had a great conversation. They seemed quite excited about us, excited about our mission because we're impact-driven. So I thought, okay, let's do the second conversation. So we did. And again, the conversation seemed too good to be true because we had more questions to them than they had for us. Now, naturally, as I worked with the VC before, and also I'm a former journalist, so I like to use the open search intelligence and all of that. I started doing my due diligence on them. I spoke to the founders from their alleged portfolio, and of course, turned out to be shady. One of the founders from their pipeline slide in their deck had a term sheet from them a year ago. They signed an agreement. The capital was never wired. And she had far more prominent investors in her round, like Bessemer and other names like that. Now, I'm glad I did that due diligence, but what brings me to my question is that we're a small startup. We're obviously not entirely hopeful about raising from those big names at the moment. So we're basically forced to look for maybe smaller funds, maybe not so prominent funds. So a couple of questions I have is, do you have any advice for vetting those funds, those smaller investors and VCs that don't have a reputation in the market yet to avoid such pitfalls? And how do you, as a bigger, more prominent investor, look at those names on a cap table of a startup that you're considering? And if you ever had any cases like this, because that founder that I spoke to, she had a lot of problems with her VC investors that were on that round. They were very pissed with that investor that let her down. And it obviously caused her a lot of problems with her building process and the consequent funding.
Yeah. I mean, what I don't understand is, like, what would motivate somebody to pretend they're a VC and spend time talking to you if they don't have any money. So it's kind of, my sense is, although it is a cautionary tale, that it's probably not that frequent, and you should, if you're raising money, just bloody talk to everybody. And you know, we're raising money for our fund, and I've had a few, like, you know, dodgy people that pretend they're LPs. LPs is what we call investors as a fund. And they were like, oh, we'll put £1 million into your fund, but we need, you know, and we'll help you raise 5 million from our network, but we need a retainer to do that. So you're like, okay, well, if they give me £1 million, I'm happy to pay them a retainer. And then the first call is like, we'll put the $1 million in, and then you pay us a retainer. And the second call is you have to pay the retainer first, then we'll put the $1 million in. And then you're like, and then I'm like, that sounds dodgy. So I know why they're doing it, because they want me to pay them a retainer, and then they're actually fraudulent, those people. I don't understand what they're getting out of you. So I would just crack on. If you're raising money, talk to, you know, it's quite difficult to get meetings. Talk to everybody, you know, try and figure out quite early on, do they lead or do they follow? I mean, so that's one question you should be asking early on, like, can you lead these rounds? What's your typical check size? And then if you've had a good meeting, and you know, typically they should have a website, but does anybody else have experiences of VC? You do?
Something similar, but not exactly the same. So basically, there's a new model whereby there's these VCs that name themselves as VCs, but then actually you go through calls, and then at the third call they tell you. So basically, the way we work is a different model. We you tell us your tech cost, basically, like what portion of your raise is going to be towards like developing your product, and they have a team somewhere like for example in India or whatever it is, and they're like, okay, and we'll put down basically half of the tech cost, we'll cover it by labor, and we want equity in return.
Yeah.
And that's like at the third call. But it's terrible because they don't lead saying that's their business model.
Yes.
They're not actually investing
Yes.
tickets in terms of like cash for equity, they're investing like work for equity, which is costing them a fraction of the price because obviously they're outsourcing it to an offshore team. So
Yes.
in my opinion it's a scam, but I've had quite a few of those.
Yeah.
And how open are you with, like, if a founder asks you to be introduced to, like, investee companies or different people, are you quite happy to do that? Are you quite happy to facilitate that?
Yeah. We say we'll either give you some or just randomly, because we say you should technically randomly choose from the website, because if you ask me to select, I'm only going to select the people that like me.
Yeah.
Do they ask? I mean, again, people have LinkedIn. We have our website with our portfolio. It doesn't take a rocket science. So any of you, if you connect with me on LinkedIn, I'll have typically 100 to 300 mutual connections with any one of you in this room. So even, before we invest, we're going to ask you for references, which you're going to give me the people that you want me to talk to. But I'm speaking to people that are mutually connected to you, already. Now, they may be better friends with you than they are with me, so they may even message you and say, do you know this guy Jean was asking about you? But yeah, so we check people out through our network, and you should check people out through your network as well.
Okay. Question up the back.
I'd like to say, just first off, been around the block a couple of times, but this is one of the first fireside chats where genuinely very insightful stuff in a very long time. So thank you for your wisdom, which you've gained over the past decade of investing.
Thank you.
I'd say, obviously, with the advent of AI, times have pretty much been flipped on their head a little bit. It used to be okay to say, okay, how are you going to spend the money? And they'd say, well, 60% development, 30% marketing, 10, 20% sales, etc. Whereas now I'd imagine if they say they're going to spend 30% on marketing, you're going to say, well, what about ChatGPT for your marketing, or something to that effect? So with AI, how much are you expecting people to reduce costs in certain departments due to being able to, or at least the assumption that they can use AI to be able to replicate what humans or interns will be able to do, which now we can use some other programs for?
Yeah, I mean, definitely AI cannot be ignored. We're not like a deep tech investor that's looking at like foundational models, but every tech business we're looking at is using AI to have an unfair advantage over the competition. And the other thing that I forgot to mention, like what we really like at pre-seed is like we like a wedge product. So we like somebody who's going, if the market is this, they're going into one wedge, which, for example, we invested in Jarvis, which wants to disrupt the pension space. Now, pension space is a big space, but they're focusing on the gig economy workers, and their route to market, their traction when they spoke to us was, we've identified umbrella organizations. So an umbrella organization is somebody that helps freelancers and gig economy workers manage their employment contracts with multiple vendors. And none of this group have got, or 50, the official stats are 50% of freelancers have pensions, but the reality is only 20% have pensions. So this automatic auto enrollment that everybody gets with employers hasn't moved to that gig economy, which represents 5 million people in the UK, and they tend to be frontline workers, and they tend to be in our target demographic of low-income communities. So that was their wedge market, was to go in to that gig economy, and their ambition is to go across all pensions, but starting somewhere focused and small, if you want to call it that, and then being able to expand is great. So we love businesses that have like that wedge that can turn into a platform. So if, let's pretend you don't succeed in becoming a platform, then, but you either fail or you exit, let's say, forgetting the zombies for the moment. If you're a widget or a wedge, we'll get a 1 to 5x return on that. If you become a platform, that's when we get the 10 to 100x. So 80%, 90% of our exits are going to be to private equity and private equity-backed businesses. And what a private equity basically do is they buy platforms and they connect widgets to it. So if we're going to be selling to a private equity business, you want to be selling the platform, and then that private equity group will then buy a bunch of widgets to add to that platform. So when we invest, we're always looking at that dual lens. It starts as a widget, but can it become a platform? And if they fail in the platform, we can at least get our money back plus 5 times. If it goes to the platform, that's when we make the big exits. So that's another thing that we look at, that widget platform play.
Last few questions.
Hello. Hello. What do you think about benefit corporations in United States, as for example Patagonia and the majority of big impact companies right now?
You mean like a B Corp type thing?
No, B Corp. B Corp benefit corporations like in a structure, legal structure, that in your bylaws appear that you're gonna be bringing impact, to your business decisions. Is something that in the UK is like some companies are structured that way, or there is not, that just be corporation, that is just the certification?
I mean, when we invest through our impact funds, we put into the articles of association that the objective of the business is not all about shareholder value, but it has to be to the benefit of the goals of the company as well. And then we will write those goals, which will be part of our impact kind of KPIs. And the goals in our impact fund will typically be, somehow reducing social inequality. So we do change the articles of association to have a dual purpose beyond just shareholder value. And we introduced that in 2018. And even WageStream, which is, we did pre-seed in 2018, they've gone up to Series C, Series D with Balderton, Northstone. Even those big monster VC firms haven't removed that mission statement from the articles. So we started that in 2018, and all of our investments in the impact fund have that. And initially it was quite difficult to get founders to sign up to it because they thought it was somehow going to scare off other investors. But now that we have a track record of having done it 50 times and nobody has had a problem with it, then it's much easier conversation now than it was.
Okay, 2 more questions.
Hi, so I was interested to hear what you were saying before about founders. What's your views on having 2 founders, but also somebody who is in a marketing role as well? Is that considered to be something that you don't like? The third one's not a founder, but I just want to get a sense of it.
So sorry, 2 founders?
2 founders and then like a CMO type person.
Oh, I love CMOs.
Okay.
No, I said at least 2 co-founders.
Oh, right. So
I don't mind 3 co-founders.
Oh, cool.
I think once you get to 4 co-founders,
then it gets too much, probably.
No, it doesn't get too much. I mean, when you get to 4, I think 3 co-founders is actually great.
Yeah.
And we have invested in loads of solo founders. We've invested in everything, right? But I've told you why I like, the technical co-founder is important for us as well. But yeah, 3 co-founders is fine. And then, big question is, how do you break down responsibilities? Once you get to 4 co-founders, that means you get an option pool of 10%. You're going to be doing your first round at 20%. That's 30% of the equity's gone. Suddenly 70% between 4. You're getting below 20% each, which is fine. But it gets a bit, dilutive. And you need all those different skill sets early on.
Okay, that makes sense.
Thank you. And final question.
Hi, my question's around whether you only lead a pre-seed round, and if not, how do you assess like follow-on or joining a pre-seed round as a, if there's like a lead?
Yeah, so
and just to close off, I saw you also have a Ascension Syndicate, and whether there's anything that goes there as well.
Yeah, so our institutional fund, the one that I run, which is the impact fund, we like to lead. We like to take 10% of the business in the first investment, and we assume that the first investment is 20% dilution. So if you're raising £1 million, we'll put in 500K. Somebody. Our ideal structure is us putting 500K. 3 to 5 value-add angels putting in, 300K, 250, and 250, 300K, and then maybe a smaller fund putting in 250 of $1 million round. That's our ideal structure, and we like to lead. We can not lead, but typically we want 10%. That's our model. So we can, we have in our thoughts that if we lose a battle against another VC, which can happen, we can lose, then they can take 10%, we'll take 7%, and then that leaves 3% of the equity for the angels. In our SEIS funds, we typically put 200K in, so we can lead or not lead there, because if it's £1 million round and we're putting in 200K, we're probably not going to lead. If it's a 500K round, we could lead with 200K, and then our syndicate is very useful for 3 reasons. We've got about 600 active angels in the syndicate, so number one, they bring us deal flow. So out of the 7,500 deals, the angels are the kind of lifeblood of early stage investing, so they bring us great deal flow that they might want to put 50K into a business. They come to our funds to maybe top it up. They help us with follow-on or co-investments into the existing portfolio, and they can be added value and have deep sector knowledge, which can help us with our DD, but also help with the founder scale.
Brilliant. Thank you very much, Jean. I think that was fantastic. Thank you. Thank you very much.
Thank you. Thank you very much. Thank you very much. And let's give them a round of applause once again, please. Thank you. And we're about to wrap up. But before we go, we do founder spotlight. So this is just to call on one founder to come talk about the business. We do it every month. So if you want to showcase next month, just let me know or let Matt know. So I'm going to call on Vincent from Alata. Let's give him a round of applause as he comes up on stage. Thank you. Thank you very much.
Hello. Hi, everybody. My name is Vincent Olagomide. I'm a software engineer, a cybersecurity engineer, also a salesperson. Jane was talking about solo founder. I think I'm a solo founder with all the expertise that I need. All right, so this is Alerta. Some of you might be developers here. I'm sure you've heard of Sentry. If not, Sentry is a tool that allows for error monitoring and alerting, right? And that is exactly what Alerta does, but more. Now, if you look at it, it says instantly know what happens whenever it does. So imagine a tool that helps you to know what happens whenever it does. Now, what happens like what? So for example, in the early this year, if you know Nuance, that's a crypto firm, lost $8 million. Also, Bybit lost 1.4 billion last 2 weeks, right? Now, the first lost, which is $8 million, it happens that the attackers were sending out $7,000 every time. And now, imagine nobody knowing about that, and they lost $8 million, right? So Alerta can actually help you to know. Imagine this happening, let's say, 3 times, and you are here, right? You are the owner of that company. Now, when you see that alert that, okay, $7,000 is out, you're not able to trace it, you can easily talk to your colleague or just take an action with Alerta, right? So if you look at here, the solution, right, is instant alerts, either on desktop, mobile, via Slack, of course, real-time login, tracing, and monitoring, fast team and customer issues notification as well. And the impact so far is 30 million alerts has been sent. So as it is, it's revenue generating. A company is already using it. And we are a team of 3. Of course, I'm the founder, and we have a salesperson, and we have a digital marketing associate. They are basically pushing, because I'm coding, of course. I've done some sales to bring this business up, but they can go ahead and continue to bring more people, right? So that's basically what Aleta does. You can go to usealeta.com to try it out. It's free for 5,000 tokens you get for free, and then after that, you can subscribe to any of the packages we have on the website. Thank you.
Thank you very much, Vincent. And if you want to showcase your startup in subsequent months, just reach out to Matt or reach out to me and do that. So we have an upcoming event. This is a ritual we do. Yeah, we have an upcoming event on the 20th of March, and you can use the code VIP to get access to it. It's next month is International Women's Day, so we're talking about personal branding for startup success. So we discovered that there's this disparity between women and men. So men tend to go out there, post their ups and downs. So this panel is an opportunity for women founders to come up and learn how to how to brand themselves, like personal branding, right? So we've got someone from TikTok, we've got CEO of the Brand Audit, she's into PR, she's also ex-TikTok and ex-LinkedIn. We've got the founder and CEO of Sleep, and we've got Enino, she also works with WeWork, and she's also ex-LinkedIn, so able to, there's a lot of learning to be unpacked. And if you want to attend, use this code VIP to get a free ticket. So there are only about 15 tickets. So yeah, be fast about it. And that's it. So thank you everyone for attending today's event. I'd love to see more of you. Thank you.